Hey everybody, welcome to Market Outlook 2025. I promise I am not contributing to the fear-mongering that's going on out there these days, people trying to call the top of the market, but I am kind of sarcastically joking around here when I say, is this the year of reckoning for Wall Street? So what we're going to do is we're going to look at the weighted evidence as we always do here. We're going to look at the pros, the cons, the good, the bad, everything in between, and get a really good look at honestly what's going on in the market and how healthy does it look. As a quick agenda, we're going to talk about U.S. stocks, international stocks, bonds, fixed income, commodities, intermarket analysis, relative comparisons between asset classes, sectors, and more. Digital assets like cryptocurrencies, same thing, do some relatives there. Look at breadth indicators, see how deep the participation goes in the market, and then a bunch of indicators, tables, charts, and things that kind of give us a really good idea of what the big picture looks like in the market right now. Before we get started, real quick, on the left-hand side, there's a QR code there. If you'd like a second opinion on your retirement plan, your portfolio, or if you don't have a financial plan, you should. So on the left-hand side there, you can use that QR code to take you to a questionnaire that will help you determine whether or not we're a good fit. We can set up an intro call, have a little chit-chat, and then go from there. On the right-hand side, if you'd like to connect with me on LinkedIn, that's what that QR code is for. Of course, all the socials are there at the bottom. And then if you'd like to get a hold of us, whether you're a financial advisor looking for this slide deck, an investor looking for the slide deck, or if you just have questions, you never ever have to be a client to ask a question, and you can reach out there at info@libertaswealth.com. All right, let's go ahead and jump in. Big quote guy, for those of you who have been following me at all this past, forever, anytime, 23 and a half years now, believe it or not, but I've always been one who collects quotes, and I've got two today. First is the late Art Cashin, who we unfortunately just lost this past year. Art said, "You never bet on the end of the world because it only happens once. And even if it does, who are you going to settle the trade with?" So what he's basically saying there is, at the end of the world, if you sell because you're worried about the end of the world, there's nobody going to be on the other side of the trade to buy it anyway. So yeah. Another quote, one of my favorites of all time, Marty Zweig. He said, "It's okay to be wrong, but it's unforgivable to stay wrong." And this is always applicable, no matter what the market's doing. It could be going up precipitously. It could be going down precipitously. It could be trendless and choppy. But investors, humans are not the best investors in the world. And as a result, what ends up happening is people have a tendency to hang on to their investments when things aren't going so well. So whether there's rotation going on in the market, whether you have an investment that's starting to bleed, it's okay to be wrong. In fact, you are a really, really good investor if you're right about 60 to 70% of the time, and that is really good. Obviously, there's nothing wrong with a little luck as well, but when things go against you, when the trade goes against you, when the market climate isn't working for you, it's okay to be wrong because, again, it's not that you're wrong, it's that the analysis was wrong, the market changed. Then you have to change along with it. You have to adapt, and you have to reallocate. You have to make changes depending on the market climate and the prevailing landscape. So again, it's okay to be wrong, but it's unforgivable to stay that way. So let's jump into the material. Let's talk about U.S. stocks first and foremost. As we look at a lot of the news that's been going around, there's a lot of people talking about how top-heavy the market is, saying that the top holdings in the S&P 500 are getting too big. And as of right now, the top 10 holdings in the United States stock market, call it the S&P 500, right under 40%. But when you look at this, Ryan Dietrich, friend of mine, pulled this chart up, and you can see the average is 58%, which is a whole lot higher than the 38.8 where we sit in the U.S., but there's a lot of other countries whose top 10 stocks are a lot heavier in terms of the weight within their index. So I don't know that this is all that founded, or if it's, maybe it's just talking points, something to get people excited and talking on the news. So for me, I don't think it really matters all that much. That's my opinion. When we look at the stock market in general, so we start with the S&P 500 here. Couple things. First of all, the 200-day moving average is sitting right around 5,600 on the S&P. We just hit new all-time highs on Thursday. And by the way, all-time highs are not bad. And if you're thinking as you're listening to this or watching it, well, if things are all-time highs, we want to make sure we wait for things to get cheaper before we buy. Famous last words. When the market's hitting all-time highs, that's good. It shows that it's strong. And oftentimes what we'll hear from investors is they want to wait for things to kind of pull back. They don't want to buy at all-time highs because they don't want to pay high prices. I have two things to say to that. One, when people wait for things to calm down and wait for prices to come down and wait for a better deal, so to speak. What they end up doing when that deal takes place, when that sale arrives, is they'll typically say, well, things aren't going well right now. I want to wait for things to get better before I buy, which basically means you're going to wait for prices to get higher again. So human psychology, again, is something that makes humans not the best investors in the world. So just keep in mind, it's not about buying low and selling high, or finding the deal and finding the value, bargain, clearance rack, and, buying low and selling high. It's all about buying high and selling higher. You're not going to go selling all your investments next week, next month, or even next year. Most of us have years left to live, and we're trying to make this money last as long as we do, or longer, obviously, so that we can get and stay retired. So just keep that in mind. Another S&P chart here, aside from the fact that we're unequivocally in an uptrend, kind of a piece of resistance just north of 5,600 are the highs from summer of 2024, followed by a couple little pullbacks here to what was previously resistance, which now becomes support. And that's kind of an important line in the sand here. So along with the 200-day moving average or the 200-day trend line, I think that this line in the sand is kind of building almost a convergence there of indicators or levels in the sand that I'm paying attention to. When we look at the downside, so yes, the market's in an uptrend, things look good and healthy. One piece of negative evidence is the negative momentum divergence that's still showing up on the charts in RSI, or a momentum indicator there in the lower pane. So what that basically means is, as we see higher highs in the market, what we want to see is similar highs, or at least, because this is a bounded indicator, it can't keep going higher and higher and higher. It stops at 100, goes to 0. But we don't want to see this. We don't want to see a high and then a lower high and an even lower high as the market continues higher in the above pane. So what this is telling us is it's hinting that the market may roll over at some point in the future. But it's, again, like so many things when it comes to investing, you can't look at this like a light switch. You can't say, well, because this one thing's happening, that means the market is going to go down. It's a hint. It's one piece of evidence among many pieces of evidence. So you have to look at it almost like a dimmer switch, or said another way, you have to look at it like this is just one instrument in the orchestra that makes the music. And just because one little instrument plays a bad note doesn't mean the orchestra is off altogether. So, but it is something we're paying attention to. And like I said, it's one of the few pieces of negative information or negative web evidence that I'm seeing. Next thing I've been paying a lot of attention to. In fact, it was funny when I pulled this up. I was actually looking at my template from last year, and the market outlook last year, we were looking at a potential bull trap, not bear trap, right here. When the market had, not the market, but the small caps had broken out above this kind of line in the sand right here across these highs that I'm drawing my mouse across. And it ended up kind of pulling back and then heading higher and then pulling back, and eventually it did really break out and stuck. So where we're at now is that we're at this point of potential resistance here, going all the way back to fall of 2021. So while the S&P has printed higher highs, higher lows, all-time highs over and over and over again, small caps have really been lagging behind. And in order for this market to continue higher, we're going to have to see mid and small caps participating in that uptrend. We can't just have big cap stocks, and mega cap stocks doing all the work. Eventually it becomes too heavy, and they'll pull the large caps down and the mega caps down with them. So if we look at this like these are the troops, and the mega caps and large caps are the generals are leading the troops into battle. And what we really want to see is we want to see this kind of big, huge, you could call this a cup with handle pattern. We want to see this big, huge base play out here. Here's the handle. We want to see that break out to the north, get above these all-time highs right there, which is marked by the most recent highs in fall of this year. And then we could see a really, really strong move for small caps. So paying a lot of attention to that as well. This is in a relative rotation graph, so an RRG for short. In the middle is the S&P 500 at the 0 point. And then what we're looking at is the rotation of the U.S. sectors in the U.S. market around that S&P 500. So bottom left, lagging in the market. Upper left, improving. Upper right is leading the market. Lower right is weakening versus the market. And as you can see here, this little ticker here is going closer and closer to now. Unfortunately, I can't pause it. But you can see here how real estate was leading about 6 months ago, started heading into the lagging quadrant. And now the things that we're seeing that are starting to lead the market are things like consumer discretionaries, communication services, and the offensive sectors. And that's kind of one of the things we want to pay attention to. So are offensive sectors winning, or are defensive sectors winning? Because when you start to look for signs that the market isn't doing well, what you want to look for is, are there defensive sectors or defensive investments starting to outperform? Because that would be a really, really good hint, a clue that things are starting to get bad under the surface. We're starting to see some trouble. When we look at the sectors that I like, some of the best sectors in the market right now, industrials is up there. So this is the chart for the industrials. And what we're looking at in blue is just a 200-day moving average, or in other words, a 200-day trend line. So it's the average movement of this investment over the last 200 days, which kind of smooths things out. So what we're looking at here is, first and foremost, we've got a 200-day moving average that's trending up. We've got higher highs, higher lows in the industrials, and we have industrials trading above that rising 200-day moving average. So green, green, green as far as I see. Next is technology. So we've got technology, again, higher highs, higher lows, above a rising 200-day moving average. Nice positive trend here. So nothing to shake a stick at, looking really, really good. Consumer services, same story. Rising 200-day moving average. Consumer services ETF trading above that, higher highs, higher lows. Again, technology here. This is the Spider Technology ETF, also a rising 200-day moving average, also higher highs, higher lows. You could argue there's been a little chop here, going back to May of last year. The ETF's in a similar place, but again, I'm not too concerned. When you look at the technology sector overall, it's looking really, really healthy. Now, when we look at a couple individual stocks, I know I mentioned last year, and I believe the year before, it might have been in one of the quarterly screencasts that we do, not the annual market update. We talked about the GLP-1 drug stocks. So in this case, Novo Nordisk, Ozempic, companies that make the GLP-1 drugs. And this was a great stock to own for a long time until it wasn't. Or said another way, the trend is your friend until the end when it bends. And, we had this stock for a while, but at the end of the day, it doesn't really matter if people are still buying this drug. It doesn't really matter if they're selling record amounts of it. It doesn't even matter if they don't have enough to go around. At the end of the day, if more people are enthusiastic about buying the stock than those that are unenthusiastic, price must rise. And in this case, what we're looking at is a situation where it didn't matter what this company was doing, what they were selling, how much they had, supply and demand from a product standpoint. What really mattered at the end of the day was there was more selling enthusiasm than buying enthusiasm, so price must fall, and that's where we're at. We had price topping out here right around $144, $145 per share. Now it's sitting at $80 a share. So almost 50% drop in value. No fun whatsoever. You don't buy stocks and hold on to them because of fundamentals. You don't hold on to them because you like a stock. You don't buy a stock and hold on to it because you think it's going to go up. You don't buy it and hold on to it because you think it's going to come back. You put a set of rules together. You follow those rules no matter what. And then sometimes when you're wrong, you don't stay wrong, right? Going back to the quote of the day. Similarly speaking, Eli Lilly, even though not as nasty, Eli Lilly also was a great stock to own and also a GLP-1 drug maker. But again, it broke down, gap down here. You can see here in fall, got below water. This is the 200-day moving average. I always say it's below, just as an analogy, it's below water when it's below the 200-day moving average. So it fell below the 200, tried to get back above water, couldn't, and now it's drowning. So again, not as bad as Novo Nordisk, but still not so great nonetheless. Not a stock we would want to own. On the other side, stocks we like, stocks we do want to own are ones that are going up. There are stocks with higher highs, higher lows. There are stocks that are trading above their 200-day moving average, and in a perfect world, a rising 200-day moving average. So exhibiting relative strength. And one of those is NVIDIA, which I'm sure we've heard plenty about this past couple of years. So NVIDIA looks great. Another one would be Broadcom, another company that's involved in AI, just like NVIDIA. Broadcom gapped up here recently, has had a really, really good few months. So Broadcom, higher highs, higher lows, rising 200-day. Netflix also looking really, really good. So Netflix is another great stock right now. Intuitive Surgical is also another wonderful stock. Great stock that would be a great consideration for portfolios. And full disclosure, we do own these stocks. We own these stocks. We own the sector ETFs I mentioned earlier as well. So just full disclosure. Switching gears to international stocks. International stocks don't look bad. I want to start by saying that. In fact, if you're watching this and you're thinking, okay, maybe you're trying to get ahead of me and say, oh, look, rising 200-day moving average, higher highs, higher lows, right? This is the All Country World Index. So it's, all the stocks around the world. And it doesn't look bad, right? Here's the problem. When we do a relative strength comparison, so in other words, a relative comparison between the S&P 500 and, in this case, the EFA, so Europe, Australasia, Far East. So this is a large cap developed markets overseas. Because EFA, so large cap international, is in the first one, and then S&P is the second one. Whatever is second is what we're comparing it to. So if it's going up, then that would mean the first one's winning. If it's going down, the second one is winning. So in this case, because we can see here on a relative basis that going back to May of 2023, not 2024, but 2023, you can see here that EFA has been underwater versus the S&P. So in other words, what this is telling us is that United States stocks, so the S&P 500, has been an outperformer versus large cap international for a while now. And we haven't even seen it try to break above water here. It's just been underwater drowning the entire time with no signs of bottoming. Now, if you're looking at this over on the far right edge of the chart here, and you're seeing this low, and now it's kind of starting to come up, just keep in mind it did it here, it did it back here in early 2024, it did it again right here in July, summer, August of 2023. So just because it's showing short-term highs doesn't mean it's the bottom. And by the way, people shouldn't try to pick bottoms. Only monkeys do that. When a hedge fund manager told me that once, I thought it was kind of a funny, nerdy joke. But anyway, so that's international large cap versus U.S., obviously in favor of U.S. This is small cap, emerging markets. So this is small companies overseas relative to S&P 500, large cap here in the U.S. And you can see, again, downtrends. So in other words, small cap might have a little bit more strength here because you can see a little, pops above water here, 2023, 2022. Here's one in fall of 2024 where we saw small caps internationally pop up above water. But still, we've got a descending trend line here, and it just doesn't look good. So when I look at this, I see S&P 500 U.S. stocks are better than international small caps. Pretty simple to me. And then this is All Country World Index ex-US versus S&P 500. So again, while I showed you earlier that the ACWI looks good, just in general, when you compare it to US stocks, it doesn't look good anymore. Not at all, actually. So it's very obvious to me that if we're looking to decide between U.S. and international stocks and which ones are better, which ones are stronger, unequivocally, I think it makes more sense to be in the U.S. And it has been for a really, really long time. In fact, it's been that way for a super long time. How long? Pretty much since 2009. And you can see here that since 2009, U.S. stocks have pretty much been the leader compared to the rest of the world the entire time. So, and another thing, the reason this is important, by the way, is because for people out there that are just, hell-bent on beating the market, that trying to beat the market, it's extremely difficult to do when the U.S. market, and, if you live in the U.S., is the best market. It's a little bit easier to beat the market in years like 2001, 2, 3, 4, 5, 6, 7, where you've got this underperformance versus international stocks. So now you can buy international stocks and take advantage of, let's just say, a falling U.S. dollar to outperform U.S. stocks. But if you can't do that, then it's going to be really, really, really tough to beat the market. So I would say that just to share with you that, maybe don't focus so much on beating the market. Most people that I know are trying to retire on time, stay retired, make sure they don't outlive their income, hit every item on their bucket list. That's what you should be focused on, not beating the market. And then speaking of the U.S. dollar, here's the U.S. dollar. This is the U.S. dollar index. And one of the reasons why international has been struggling is because the U.S. dollar is doing so well. And in other words, if the U.S. dollar is strong, then U.S. stocks are going to outperform international stocks, all things held constant. If the U.S. dollar is weak and starts to fall, then that means that international stocks are going to outperform U.S. stocks typically. Again, all things held constant. So what we see right now is this kind of point of potential support here going back to late 2023. We see a little bump here. It breaks out above it. It's pulled back to that same line in the sand. And we're just going to kind of have to see if it holds that level. And even if it doesn't, even if we see some big, huge chop here between $100 and then call it on the high here, going back to, we'll say 115, going back to summer of 2022. I don't think that's going to make international stocks all of a sudden super attractive. I just think that could just see more volatility in this relative comparison. So let's talk about bonds a little bit. So bonds don't look good. You would think that because the Fed started to cut rates that you would start to see rates go down and then bonds go up. But instead, the Fed really hasn't done a whole lot of cutting. And as a result of the fact that they haven't done a lot of cutting, instead what we're seeing here is this kind of putrid bond performance. This is just the aggregate bond index, ETF, AGG. And then if we look at TLT, so 20-year treasuries, it doesn't look any better. In fact, it looks worse. So when you're looking at long bonds, whether it's long-term, intermediate term, even shorter-term bonds, 7 to 10 years here, still do not look good. And while it did make sense to dip our toes in the water here, and we did own bonds for a little while in fall into the new year, it just doesn't make sense to hold on to them anymore. We need to see this kind of bottoming process take place at this juncture and really see more outperformance before I think we can trust the trend. So some bonds that are doing well, though, because there's more bonds in the market than you realize. Most people don't realize there's convertible bonds, there's high-yield bonds, there's floating rate, there's inflation-protected securities. So there's lots of different choices within the bond market, and some that are looking good, which, again, I want to be full disclosure, we own these in our clients' portfolios. Convertible bonds, first and foremost. So we are along convertible bonds, and we also own high-yield bonds. Just, again, another piece of education here. High-yield bonds and convertible bonds have a tendency to correlate pretty highly with the stock market because they are higher-risk securities. They're not super safe, AAA rated, insured by any stretch of the imagination. So that's one of the reasons why they're doing as well as they are. But, again, the safer stuff, which is kind of ironic that you can call it safer, but it's underperforming, right? But the safer stuff like your long-term treasuries, intermediate-term treasuries, corporates, things like that, commercial paper, not doing so well. So be really careful with your bond portfolio or the bond portion of your money because kind of like between 2022 and 2024, when bonds were just absolutely decimated as a result of rates being hiked higher and higher and higher, because, again, they're inversely related. Rates go up, bonds go down. We don't know that rates are going to be, get cut heavily. And until rates start going down in any measurable fashion, it's going to be really difficult for bonds to kind of get any traction here. So be really careful what you're buying in the bond market. Change gears, talk about commodities here a little bit. Gold, we'll start with gold. Broke out last year, and it broke out pretty decisively here. You got 1, 2, 3, 4, 5, almost 6, is that? 1, 2, 3, 4, 5. Yeah, 6 days in a row where it just screamed northward. That's kind of what you see at points like this, breakout points. Then it kind of consolidated for a little bit here, kind of a little pennant or flag pattern, headed higher again, chopped sideways, headed higher, and now we've got a new base being built. The question is, of course, can gold head higher? And a lot of that's going to have to do with interest rates and inflation and the U.S. dollar for that matter. So those three things are going to be really important here in determining whether or not gold can hold on or if this is kind of be the end of the road and maybe a new period of consolidation for the yellow metal. When we look at gold versus the S&P 500, so S&P is the numerator here. So what we're looking at is kind of choppiness. In other words, this is a relative comparison chart between S&P 500 here in the U.S. and then gold futures. And what this tells me is that there really is no leader. So while some of the other comparisons I've shown you have been pretty decisive, like U.S. versus international stocks, U.S. versus small cap international, things like that, this is not decisive. So they've been performing pretty closely together is what this says, essentially. So no real information here other than that it's trendless. And then when we look at silver doesn't look nearly as good as gold. You've got this really, again, multi-year breakout here, but then it pulled back below that line, jumped back above it again, printed an all-time high, pulled back to that line in the sand, which in order for silver to continue improving in terms of relative performance and absolute performance, we're going to need to see that line in the sand hold. If it can't hold this line in the sand, then it's kind of back into the range again. So that's silver. And then oil. Oil's starting to perform well, both A, based on the administration change, and then B, seasonally speaking, oil has a tendency to outperform during this season. So I don't know that it's something I'd want to touch. We don't own any oil. in our portfolios, and I think there are way too many other better things that you could own in your retirement portfolio other than oil, regardless of what you might be seeing on financial news, blogs, articles, things like that. So be careful. And speaking of seasonality, here again, this is Ned Davis research, actually the same one that we saw last year. And you can see here that between January, February, March, and April tends to be, some of the seasonally best time of the year for oil. And then July through November tends to be the seasonally weak time for oil, which might even be contrary to what you might think. You might think travel season's good, whereas winter would be quieter, but that's not the case. So don't trust the fundamentals, right? Trust the numbers and trust nothing else. All right, intermarket analysis. Let's look at some intermarket relatives comparisons. Again, I already showed you this U.S. versus international. So this is S&P 500 versus international ex-U.S. So zero. This is not a world index in this case. This is just international stocks outside the U.S. And you can see here, again, unequivocally, S&P absolutely outperforming the international indices. So S&P all the way. This is the S&P versus small caps. What I find interesting is that we're starting to see some real choppiness here, some meaningful kind of sideways movement in the comparison between large and small cap stocks here in the U.S. Now, large cap still wins, so large cap is still the better index currently, but we're starting to see kind of this this triangle pattern forming. If you follow my mouse here, we've got a low and then a higher low, and if you draw a line there, that would create an ascending trend line. And then you've got this high and a lower high here, which is creating a descending trend line, which is creating a triangle pattern. And I think that we're going to have to see how this resolves, but it would not surprise me to the least to see it resolve to the downside. And if we go back to that small cap chart, and again, if we see small caps break north of this line in the sand here, this overhead resistance, it could look a lot like gold did when gold broke out. We're just going to have see what happens here. All right, moving on to stocks versus bonds. I probably don't even need to show you this, but when you compare stocks to bonds, absolutely stocks are in favor. So U.S. stocks compared to bonds, U.S. stocks all the way. When you look at stocks versus commodities, same story. Rising trend line, stocks beating commodities. So even though gold is a commodity, it's one of many commodities. And in general, when you look at commodities as a basket of many commodities, U.S. stocks are outperforming and a better investment to own currently. If we look at stocks versus gold, this is the same or at least similar chart that you saw earlier, just sideways choppiness. So there's really no verdict here. Stocks have been performing with gold or alongside gold very similarly. And then I mentioned at the very beginning of the presentation that when we see offensive sectors outperforming defensive, that's good for the market. And when we see defensive stocks outperforming offensive stocks, that's obviously bad for the market. What we're looking at here is a comparison between consumer discretionaries and consumer staples. Discretionaries are luxury goods. Think of them as wants, not needs. Whereas consumer staples, they're staples. They're the things we need. Razors, not luxury goods. So as you can see here, this chart kind of chopped sideways for a long time between 2023 and 2024 and has broken out equivocally to the north side. So again, this is another, call it notch in the belt for bullish behavior. In other words, that offense is the team with the ball, and that would be risk-on, bullish behavior here. So without a doubt, discretionaries outperforming staples is a positive thing for the market. And then here's technology versus utilities. Been an interesting year, 2024, for this comparison because utilities have actually had some moments of brightness, making this not really all that decisive. In other words, it doesn't provide us with a ton of information, so we kind of have to look elsewhere. So you don't really see a decisive trend here. You do see kind of lower highs, but then you see higher lows most recently. So it's this relative comparison essentially is trading in the same place as it was a year and 2 or 3 months ago. So again, not a whole lot to glean from this chart. When we step back, look at things from a 30,000 foot view, you can see here that my long-term asset class momentum ranking has U.S. stocks at the top, pole position. Number 2, even though when you looked at that relative chart I was showing you earlier, and how, I don't want to say how bad it looked, but then, on a relative basis, U.S. stocks are still very much outperforming international, but still international is number 2. Small caps are currently number 3 on a long-term basis. And then number 4 would be cash, money market. Just barely below cash would be commodities. And down here in the basement, once again, like it's been so many times this past 2.5 years, has been bonds, U.S. Treasuries, so 20-year Treasuries here in the basement. So one more way of looking at things here would be point and figure charts. I don't want to get into details on how point and figure charts work, but what I will tell you, as opposed to using time as one of the metrics that are involved, this is taking time out of the equation. To make it as simple as I possibly can, if domestic stocks and commodities did not change at all in price, in other words, they stayed exactly the same in price for a whole year and nothing else changed, then this would stay exactly the same. In other words, you'd see 327 buy signals in the U.S. equities, 265 buy signals in commodities, and U.S. stocks would be number 1, commodities number 2. Nothing would change. So what we're looking at here is basically the price change only, regardless of time. And when you look at that, it's just a different angle, a different way of looking at things, which I know not everybody loves point and figure charts. I do. So here we've got U.S. stocks at number 1 again. So if you're not convinced yet, I don't know how else to convince you. Commodities are number 2. International stocks are number 3 in this case. And then cash, or money market, or sitting under the mattress, is number 4. Behind cash is bonds and then currencies, so foreign currencies. So, all right, let's move on to talking about crypto a little bit. I'm going to talk about Bitcoin first. There's been a lot of talk about Bitcoin lately because we've seen all-time highs in Bitcoin. And you kind of had this sideways period in 2024 where it kind of went nowhere for a long time. You can even say it had a downward bias. Here's your 200-day moving average, so trending up, and then it kind of breaks out here. And now it's just been kind of consolidating, chopping sideways, digesting price over time. And right now, the 200-day moving average is about 27% below the price. And I put that there because it doesn't look like it's very far above it, but the price is so different or so much higher than the moving average. I wanted to make sure I pointed that out. And then the other thing here is there was a negative momentum divergence like there is on the S&P 500. But the difference here is it looks like this one's failed. So this is how the U.S. Negative momentum divergence might resolve if things continue to get better, is we might see a breakout in momentum above that descending trend line, which would negate that negative evidence or that negative hint or clue. And so what we're looking at with Bitcoin right now is because this is broken down, you can do one of two things. You can assume it's broken down and therefore not invalid, or some people might say, take this tail right here, bring it up, and say that this is the new lower high. But I think that you can curve fit this all day long, and that doesn't make a lot of sense. But that's why we call them hints and clues, and not that's why we say dimmer switch. That's why we say orchestra. Not, everything's one instrument, one decision. If this happens, then that. So you got to look at the weight of the evidence. When you look at S&P versus Bitcoin, so U.S. stocks versus Bitcoin here, you can see here U.S. stocks are out of favor. So Bitcoin has been outperforming U.S. stocks, which is why you've seen it on the news a lot. There was a period of time here in summer when U.S. stocks outperformed just briefly. And again, if you go back even further, you can look at 2023 when U.S. stocks outperformed. But generally speaking, we've got a long-term downtrend here in U.S. stocks versus Bitcoin, which tells us that Bitcoin is something we ought to consider in our portfolio if we have the risk tolerance for it and the correct, or I shouldn't say correct, but the appropriate style of portfolio management being implemented in our retirement portfolio. And when I say appropriate, what I mean by that is I'm not a believer in buying Bitcoin and just holding on to it forever. And the reason for that is because not all of our clients are 25 years old. When you're 25, 30 years old and you're not retiring for the next 20, 30 years, you've got plenty of time to make a bunch of money, lose a bunch of money, do it again and over and over and over again, rinse, lather, repeat. When you are 60, and you're retiring in 3 years, you don't have time to earn that money back. When you're 70 and you're already retired, you can't afford to lose a ton of money in your portfolio having a big allocation that you're going to buy and hold in Bitcoin. You need to have some sort of risk management in place. So when it comes to buying cryptocurrencies or digital assets, whatever you want to call them, in portfolios at our office, we like to focus first and foremost on the more moderate growth and aggressive portfolios or models first and foremost. And then second of all, we like to consider them from the standpoint of both relative strength. So using relative strength as one risk management measure, and then a second being trend following. So a way to kind of have a line in the sand below which we don't want to own it anymore. So we're not just holding it forever and going through huge drawdowns that can decimate our portfolios, especially those of us who are retired. Ethereum, much messier chart. As you can see here, it's kind of gone all over the place here over the course of the past year. So Ethereum, much more volatile than Bitcoin. And then when you look at the S&P versus Ethereum, it's more choppy. I don't want to say it looks just like gold because it doesn't, but when you look at the relative chart of S&P versus gold and then S&P versus Ethereum, you'll see that they are both somewhat trendless right now. I would say like less decisive, again, less information. All right, move on to some breadth indicators here. I've only got a few today. The most important ones, the stuff that I thought kind of made the most sense, or at least made the most sense to share, is that here's the S&P 500 in the top pane. In the bottom pane, what we've got is the percentage of stocks above their 50-day trend line or 50-day moving average. And there was a lot of talk on CNBC and the news and the Twitterverse about how participation was low. In other words, with the market going up like it has been doing, to have, say, 15% of stocks above their 50-day moving average and falling is not good. That what that's telling us is there's trouble under the surface that you can't see, and that kind of goes back to the thesis that the top 10 stocks are carrying all the weight, and that we can't see that all these smaller stocks and mid-cap stocks are kind of eroding under the surface. So that's what was the thesis was, and really there was a case for it. But now that we're seeing above 52% at this juncture, so more than 52% of stocks are trading above their 50-day moving average, I'm not really all that concerned. I think that it was just a point of consolidation, and at least for now, it looks like more and more small and mid-cap stocks are starting to participate. Similarly speaking, this is a longer-term metric, but you can see that in this case, it got down to around 45 to 48% of stocks were trading above their 200-day moving average, which is more a long-term trend line, whereas that's also risen back up to 59%. So now 59% of stocks are trading above that 200-day moving average, or if you picture one of my other charts, the 200-day moving average is this. It's that whole underwater versus above water thing. So when you see that 59% of stocks are above their 200-day moving average, that means 59% of stocks in the S&P 500 are above this line right here. And then advanced decline line, a little bit more, complicated, convoluted, whatever you want to call it. Higher highs in the S&P, lower high in advanced decline line. If I'm being completely honest, I've just been looking for negative evidence because when you're a technician, a market technician like I am, one of the things that we as technicians like to do is we like to always be looking for reasons that the market is going to go down, evidence that the market is getting unhealthy when the market is going up. So said another way, when the market's doing well, we're looking for different areas or clues or evidence that the market's going to turn around and head down against us. On the other hand, when the market's going down, we're always looking for when it's going to turn around and head northward. So in other words, I don't want to say being a contrarian, because I'm not a contrarian would be somebody who's always betting against the market. That's not what we're doing here. We want to follow the trend, stay invested in whatever's strongest. I always call it that, stay invested in the playoff teams and avoid the rest. But at the same time, we always want to be paying attention to any evidence we're seeing that might indicate that things are starting to roll over and head southward. And so this would be one piece of evidence, kind of like the RSI 14 or momentum negative divergence that I shared at the very beginning of this presentation. This is one piece of negative evidence, but it's so slight. I wouldn't even put a ton of weight on it yet. I think it would take a whole lot much more time before we'd start to see this really kind of turn into something meaningful. Let's talk about the big picture. I've got a bunch of random stuff here that I want to show you, but it's really, really fun and interesting. So first and foremost is the CNN Fear Greed Index. And what this is it's a sentiment gauge. And first of all, when the market, when participants, traders, investors, when they're really, really fearful, you'll see that this gauge kind of points over here at extreme fear. When people are feeling euphoric, you see this gauge kind of points over to extreme greed. The way we read this chart is we want to pay attention to it when it's at extremes. So obviously, being at neutral, it's not really at extremes at all right now. So it doesn't really give us a whole lot of information. But if the market is in a position from a sentiment standpoint where people are extremely fearful, then we want to be looking for those opportunities to buy, opportunities when the market's turning around and heading northward. In other words, when people are fearful, things tend to get better. When people are extremely greedy, things tend to get bad, or at least temporarily anyhow. Since they're neutral right now, what that tells me is that people aren't really fearful, but they're not really greedy either. So what that means to me is when I'm seeing all this stuff online, on Twitter, or X as they call it now, CNBC, talking about how people are super greedy, that they're euphoric, that this is a bubble. This doesn't look like a bubble to me. I mean, so call it what you want, but I just see that as doom and glooming talking points. So fear and greed index neutral, not a ton of information, but definitely not greedy. The next one is sentiment traders, risk on off indicator. When it's above the this level right here, which I believe is just north of 60%. And this is a conglomeration of a bunch of indicators, by the way. So it's not just one indicator. It's like, I think there's 12 of them, if I remember correctly. It kind of puts together one indicator that's a combo indicator that tells us whether we're risk on or risk off. So basically the health of the market in the short term. So in the short term, market looks good, looks healthy. And there's a very, very short period of time here. And you can see when you go back in time this year where it was negative. But other than that, looking really good, really good. Next thing here is how did stocks do under Biden, and not just Biden, but all the presidents. And you can see here, I'm not bringing this up to be political. I'm just bringing this up to point out that stocks, they do what they want to do. They don't really care who the president is at the end of the day. But you can go all the way back to President McKinley in 1897. You can look at how Biden did, and you can look how Trump did last time, Obama, Clinton, and so on and so forth. And you can compare and contrast all you want. You can take it to happy hour, and you can argue with your friends if you want. I hope you don't. But I just thought it was interesting. Again, my friend Ryan Dietrich, he always pulls up amazing tables and fun stuff like this that I think is really, really interesting. So at the end of the day, though, the number one ranked president of all time, Roosevelt, first term, 201.7%. But at the same time, that was coming off the Great Depression. So we always have to remember where the market came from when we're trying to decide, how did it do this past 4 years under whatever president is. So, all right, moving on. I shared this in the fourth quarter scouting report. So last quarter, fourth quarter, 2024, because we had an election. And at the time when I recorded that, we didn't know what the results were going to be, but now we do. So now that we know the results, we know what the political alignment looks like, and we can kind of look at averages and history. And there's no promise that the market's going to look exactly like it has in the past. But as the saying goes, it's not going to be identical, but it might rhyme. So what we have here is a Republican president and Republican Congress, which is right here. So Republican president, Republican Congress, historical market returns have been 13% per year on average since 1949. Now, when we look at a Republican Congress having nothing to do with who's president, 14.6% is the average return. And when we look at a Republican president with no regard to Congress or the Senate, 7.4% per year. So at the end of the day, again, take what you want from that information, but you can see all the different rankings here depending on, whether it's a split Congress, Democratic Congress, Republican Congress, Republican president, Democratic president, and of course all years right here on the far left, averages since 1949. So interesting. I'm definitely not pessimistic, but then again, I'm the libertarian we all hate. So I'm kind of a centrist that's in the middle. And really at the end of the day, what I care most about is making our clients money in the good times and protecting their money in the bad times as much as I possibly can. Speaking of politics, though, here is another statistic. It's seasonality statistics this time. What I really want you to focus on is the black line. So the black line is the seasonality statistics for a post-election year. So in post-election years, which is what we're living in right now, the market tends to do well for the first 5 or 6 weeks. Then it tends to kind of pull back during the latter part of February until the beginning of March. And then from there, it kind of tends to do well right up until about May and June-ish. When May hits, mid-May-ish, we start to see a decline into the midsummer, then another rise, then a decline from August into October, and then a positive fourth quarter. So generally speaking, what we see is a return of somewhere in the ballpark of 8% per year in post-election years. But, it's not the best year of the election cycle, but it's not the worst either. So interesting stats. Kind of changing gears here. these market pullbacks. Since December 5th, we saw a market pullback almost 5% from August 5th. And I think that the market or the financial news is really trying to scare people. And don't fall for it. There's no such thing as a bull market or a positive market that doesn't have pullbacks. In fact, I believe that the market goes down 5% on average 3 times per year. And that's average. So sometimes it's more, sometimes it's less. But 3 times per year it goes down 5%. Market goes down over 10% once a year. So it's completely normal to see these pullbacks and market corrections. We're not trying to avoid those necessarily. We're just trying to stay invested in what's strongest. Again, the playoff teams. We're trying to rotate out of the teams that aren't going to make the playoffs, rotate into the ones that are going to make the playoffs, and we would keep that rotation going. Stay invested in what's in an uptrend, stay invested in what's strong, and avoid the stuff that's not strong, the weak stuff. But at the end of the day, there's going to be pullbacks. The market breathes. It doesn't go straight up. If it were, well, that'd be easy, right? So anyway. Next here, we've got another chart table from Ryan Dietrich. Again, first 5 days of the market is one of the 3 metrics that Stock Traders Almanac looks at in their what they call their trifecta. The first is the Santa Claus rally, which we did not have a positive Santa Claus rally this year, but the first 5 days of the year is the second metric, and then the third metric is the full month of January. So obviously we won't know what the full month of January looks like until it's over, but for now, the first 5 days were positive, and when you look at the first 5 days being positive since 1950, when the first 5 days is positive, then the market's up 81% of the time, 81.3% of the time to be exact, and the average return for the market that year is 14.2%. To show how interesting these stats are, if the first 5 days of the market are lower, if they're down, then the market's only up about 55% of the time, and the average rate of return is 1.1%. Pretty big difference. So, and then you're getting the average year 9.5% having nothing to do with first 5 days, 72% time the market's up. So call it 3/4 of the time. And then if the first 5 days were up more than 1%, which they weren't, 15.7%, up 87% of the time. And if the first 5 days are down more than 1%, which is 57% of the time, the market's up, and then average rate of returns less than 1% per year. So what we're looking at is the first 5 days were higher, average return in those years 14%, 81% of the time it's a winner. So interesting stats. And then here's our pre-flight checklist, just kind of looking forward, looking again at the health of the market right now. This is something that I built with my friend David Cox and Dave Keller. And it's a conglomeration of tons of metrics. I shouldn't say tons. I'm kind of overweight, exaggerating here. Tons. There's several indicators and metrics here going across large caps, the NASDAQ, small caps, and basically I'm looking for the weight of the evidence. Because I'm colorblind, I have Optima coded to give me red and blue instead of red and green. But when it doesn't give me a choice between red and blue, I have it type out green for me. So green is good, obviously. So when we look at all these metrics, this is something I can pull up and just kind of look very briefly at this without even looking at what the indicators are and say, okay, the market looks good. It looks good for new entries. The climate's good or bad, or maybe it's 50-50 or it looks bad, But right now what I'm looking at is generally pretty blue and green, right? So it looks pretty good. Next, I wanted to go over my inverse traffic light chart. Like I always do. I do this every month in our monthly market brief. I do it in every one of our quarterly scouting reports, halftime update, market outlook. And this is just a really good way of simply looking at the market and seeing kind of what's healthy, what's caution, and what's not so great. So right now we're in the green zone, which is marked by the summer highs right here in 2024, and then this pullback right here in fall. The caution zone goes all the way down to the spring lows, and then below that obviously is the danger zone. This is where, if the market were to fall this low, we probably, in our trend following models anyway, we probably would have been getting out of the market, selling things, raising cash quite a bit by then. And then there's in our strategic models, we probably would have been rotating into defensive stocks, defensive positions pretty quickly at that point as well. But right now, green is good, and that's where we're at. Market climate looks good, and I would caution you, no pun intended, to not try and call the top. Because at one point, 6 months ago, a year ago, the green zone was right here. And before that, the green zone was back here. So the green zone keeps moving. And as long as we stay in the green zone, we're fine. And the caution zone isn't bad either, by the way. Nothing wrong with the caution zone. It just means that the market's consolidating, taking a breather. That's okay. I know I mentioned this earlier, but I wanted to point it out on a really, really kind of zoomed in chart here, candlestick chart. But as of Thursday, we saw an all-time high in the market. So S&P 500 prints an all-time high. That can't be bad. All-time highs are not bad for the market, no matter what somebody tries to tell you. So don't listen to them if they say all-time highs are bad. They are not bad. All-time highs are good. Higher highs are good. Higher lows are good. That's what we want to see. Healthy markets. Then, always a reminder that, again, risk management is number one, especially if you're closing in on retirement, and even more so if you're already retired. I mentioned earlier, people who are close to retirement or already retired don't have the time to win back the money from huge drawdowns and huge losses and market crashes. So you can see here, here's the math. If you lose 10%, not a big deal. Just takes 11% to get back to even. Even if you lose 20%, 25% and you're back to even, this shouldn't take too long, right? But when you start losing 30, 40, 50%, a loss of 30% mathematically takes a 43% gain to get back to where you started. A loss of 40% takes 67% to get back to even. And of course, the easy one, you lose half your money, it takes 100% return to get back to even. And this is important, and that's if you're not spending any of your money. That's if you're not taking withdrawals out of your account. If you're supplementing your income, your Social Security, your pension income with your portfolio, then a 50% drawdown is going to take more than 100% to get back to even, which is why risk management, which is why strategic, relative strength, trend following, staying invested in the playoff teams, and avoiding the rest is so important. And to finish today, Sir John Templeton said, bull markets are born on pessimism, they grow on skepticism, mature on optimism, and they die on euphoria. And as far as I'm concerned right now, I use the same quote to finish off last year's market outlook, and the reason I'm using it again this year is because not a whole lot's changed. I don't think that we're at euphoria. I think we're probably somewhere between skepticism and optimism, depending on who you are and what news station you're watching. But I don't think we're looking at a market crash this year. I'm sure we will have pullbacks. I'm sure we will have a market correction of some sort. That wouldn't surprise me, and it's completely normal and healthy. But I don't see a huge catastrophic market crash around the corner. So with that being said, if you have any questions, please reach out to us. Let us know if you'd like a second opinion on your portfolio, retirement plan. If you don't have a financial plan, again, please reach out to us, set up an intro call, and we'd be happy to answer any question you have. As I always say, you don't have to be a client to ask a question. So thank you for your time. I hope you enjoyed this presentation, and we'll see you next time.